that we jump straight up into our discussion. Got it? So that we can jump straight into our discussion. Go like this. Okay. I think our YouTube stream is live now. Let me just ensure that I'm not going to have.
Doing this 4-second method before bed reverses.
Sorry. Let me just show that up. Okay. All right. So, Eric up here. I don't know, some names are joining my class that I don't even know where the heck they are coming from. Give me a moment, okay, as we try to just, today is the first day, so I need to get myself familiar with, get myself familiar a little bit with the names. Okay, Fabia. Okay. Okay. Let's see. All right. So I think we should be good now. Okay, so welcome again to our discussion in financial. All right, that is what I was waiting for. Wasn't having light, so I was not. Thanks be to God. Okay, should be comfortable now. I mean, I was just starting to feel some way. Thanks be to God, my light is back. Let's get excited about it. Okay, so welcome to the section today. Very much excited to have you in the next 12 weeks as we go through financial reporting, focusing on the key areas that we need to look out for to increase our chances of passing the examination. For those of you joining us on YouTube, if you have any questions, you put it in the chat. For me, I'm going to answer it. But for those of you joining us live on the call on Zoom, you can put it in the chat or raise your hand and I'm going to bring you up. Let me say straight up that our primary source of notes is going to be my notebook on financial reporting. So this is our primary source of notes that is going to be coming in at the end of the day. So this is the primary material and some of you already have it. If you don't have it, you can get a copy. It's 120 cedis. If you have any financial reporting book also, you can use it. As always, I do not shovel my books to the throat of students. I don't force students to buy my book. So if it is something you want to buy, fine. But that is going to be the source material for my classes in the next 12 weeks. That is going to be the primary source. Everything is available in there, and I'm going to make references to it. So for those of you who having it, you make sure you have it handy because we're going to be going through it in that case. So that's just by the way. Okay, so financial reporting. What the hell is that, and what do we going to be looking out for generally? Now, financial reporting, it's one of the interesting papers in the level 2, and it's a paper that is very easy to pass. The reason is that it's because of the way the paper is structured and the syllabus is structured for you to study it and increase your chances of passing the examination. So what I want you to do is that ensure that you go through this journey with us very well. If you miss a lecture, the lecture videos will be available on the portal. Make sure you watch the playback. And then if there are any queries that you have, you make sure that you reach out. Do not hesitate. Do not hesitate. Now, for those of you who already have my book on financial reporting, it is user-friendly. You can go through it, and the lecture videos covering everything you need to pass the exams is already available on the portal. So like, and in case you've not also watched our orientation session, it's under on the portal under August 2022, Zoom sessions. You can watch the orientation session there to know exactly how we are going to go through the entire structure in that particular case. So if you have not watched the orientation, make sure you spend some time to watch the orientation. It's not too long. It's a very short video that we need to look out for. Give me a moment. I'm going to be breaking a little bit just to ensure that I'm bringing the people that I need to bring on board. Okay, so forgive me today. It's going to be today because today is the first day. I want to make sure that I'm not having ghosts to join in my class. Honey. Record. Some names joining my class, cry. I don't even know where the heck they are coming from. Okay, I think we can go now. Who is that? Sigua Belson. Kevin. Oh, sorry, the name is there. What am I thinking about? The name is here, but I can't see it. Can you imagine that? Okay, so in the next 12 weeks, we're going to go through various things that we need to understand. From week 6, we're going to be having some Saturday, Sunday sessions to solve questions on key areas, key topics to enable us to pass the examination. So take note of that, add that to your schedule, that from the week 6, we're going to be having some weekend sessions coming up to enable us to practice a lot of questions to increase our chances of passing the examination. Note also that you can download the ebook and question kits under the first video when you open the course. So the very first video when you open the course, you can download the ebook and then question kits there to get access to those question kits as well, because we are going to be referring to those question kits as well as we move ahead in our discussion. Certainly not today, but from next week in that particular case. So make sure you download the ebooks and question kits on the portal to enable you to to join the class and help us to go through very well. Okay, so let me share my screen and then let's go straight up into the discussion for the day. But before then, let me say a couple of things that you need to pay attention to for the exams. Number one is that you're going to be requiring to be consistent in your studies if you're going to pass the financial reporting examination. So for those of you who have operation 2 weeks to the exams, 1 week to the exams to do shabo work, if you have that attitude, if you have that mindset, I can guarantee you're going to fail the exams, because your chances of passing the exams, it's like 2%. So I will entreat you to be consistent. So prepare a study plan. We shared the video on the portal, on WhatsApp, how you can prepare your study plan. In case you don't have the link, you can indicate, we can reshare the link to you so that you can know how to prepare a study plan. That way, every week you are committed to do something, practice something, watch a video on the study portal so that you'll be able to consistently do something in order for you to pass the examination. Financial reporting is very, very easy to pass. Very, very easy, because you know where the questions are coming from, you know the structure of the questions, and we're going to be guiding you in the next 12 weeks in doing all of these things. But if you're not consistent in your studies, if you don't work hard, then you're not going to benefit. So assignments will be given. I entreat you to participate in them, to do it. Performance evaluation test will be done. I entreat you to participate in that, to be involved in that. If you don't do assignments, you don't do performance evaluation test, the discussion of those assignments and performance evaluation tests, you will not be part. It's simple as that. No contribution, no chop. So if we give assignment and you don't do it, forget yourself if we are discussing that question. If we do a performance evaluation test and you don't do it, forget yourself about that discussion. And the reason why we do these is to be able to enable you to prepare well for the examination and pass the exams ultimately. Now, in financial reporting, we want the best at the end of the day as an overall best student. In the November 2021 financial reporting, the overall best student is our student. So came from our institution, and it was a great thing that we had there. That is the highest mark scorer, and he was the best student. Now, why do I want that? The reason I want that is you get the opportunity to get an award from the ICAG. You get a media coverage from the ICA. You get a lot of opportunities coming to you. But guess what? I also have 1,000 Ghana cedis on the line just to shower on you if you become the overall best student for the August 2022 examination. So in addition to getting the certification from the ICAG, getting the recognition and the awards from the ICAG, I want to pledge you with 1,000 Ghana cedis to do whatever it is that you want to do in financial reporting. So if you work hard, you put in the work, you put in the effort, not only are you passing the examination, but you are also getting the opportunity to put yourself strategically to rapidly become successful as fast as possible. So if there are any questions you have as we are going on, you put it in the chat for me, or you raise your hand. For those of you on Zoom, you raise your hand and I bring you up, and then we'll be able to go. For those watching us on YouTube, put it in the chat for me. I'm going to be reading all your comments, and then we'll get excited about it. So let's go straight up into the discussion, and let's start the journey, because I mean, so let's just get straight up into it. Some comments coming in on YouTube. Let me just take them through, and then we get excited. Abdul said, hi, hello. Adam said, good evening, sir. Good evening, Adna. Senam Bright said, good evening, sir. Good evening, Senam. Jacob Bab said from Nigeria. Okay. Chris Cole said from Jamaica. All right, thanks for joining us. Joseph Bab said, I'm writing FR next week, Tuesday. Okay, you can watch some video on our portal. In the mobile application, you can download it, watch some videos there, and also watch some video on our YouTube channel. It should be good in that regard. Chris Cole said, first time watching you live. That's awesome. Thanks for joining us from Jamaica. Joseph Bab said, it seems a diet has been written in Ghana. Yes, we've written one diet already. Abigail Ewuni said, first time watching you live from University of Ghana. Thank you, Abigail, for joining us. Chino said, hello, Nhyira. I would like to express my thanks and appreciation to you for the effort in providing us important lectures. Because of that, I have just graduated with BSc Honors in Applied Accounting. Wow, that's awesome. Abdullah, that's awesome. Congratulations and all the best in your next journey. Elisha said, good evening, sir. Good evening. Deborah Boatin said, please say, I'm Deborah, KNUST level 100. Please, is it advisable to start writing ICA? Yes, start it. By the time you graduate, you are a chartered accountant and you can boss a lot and get faster opportunities. So, Deborah, start the ICA. Don't wait till you graduate before you come and do ICA. Be doing it alongside now that you are, in your good place. So that is it about that. Okay, let me share my screen. Enough of that. Let's get excited about our discussion for the day. Let's see. Why my screen is not picking me up? What's it then? Come on, hurry up. Yes, we good. So let's go now. So let's see, financial reporting. The first thing I want to share with you is the key topics that we need to look out for and the key areas that we need to pay attention to, and then the exam structure and how we're going to be running our lectures in the next 12 weeks as we prepare for the examination. So how are we going to go through our lectures in the next 12 weeks? That is what we want to quickly run through, then we'll begin the journey. Key issues to be able to pass the examination. Key issues to be able to pass the examination. So number one is the issue about conceptual framework and regulatory framework. Conceptual framework and regulatory framework. Now, we may not necessarily get a question on the conceptual framework, regulatory framework, but the knowledge on the conceptual framework and regulatory framework will set the tone for us as we head on in our discussion in the entire syllabus. Are you getting it? So the examiner may not necessarily, shower you any blessing or a blessing on getting the question on conceptual framework or regulatory framework. However, the knowledge there will help us a lot. And you're going to be seeing that in a moment as we begin with our discussion. Number 2 is going to be ethics. The examiner is excited about this topic because ethics has become fundamental for in the profession of the accountant. And so it is crucial for us to understand the various issues about ethics. And we're going to be spending time to look at how ethics questions will be set and how we were going to be answering that in order to pass the examination. So that is the second crucial thing that we need to look out for as we prepare ourselves for the exams. Then the third thing is going to be evaluation of financial statements. Evaluation of financial statements. Now, when it comes to dealing with evaluation of financial statements, we are looking at ratio analysis and then interpretations, okay? Ratios and interpretation of the ratios. That's what we are looking out for generally. Ratios and then interpretation of the ratios. That's what we are looking out for. A crucial area, the examiner is going to be definitely bringing a question up. So you have to make sure you understand that very well. We're going to spend time to go through it. And so you ensure that you understand exactly what is going on to increase your chances of passing the examination. So we're going to be getting ourselves into that later on in our discussion as we move ahead in that particular case. Just give me a moment. Somebody is joining my meeting. Let me see. Who's that? Okay. Yep. Number 4. The fourth area that we need to pay attention to will be the issue about, the IFRSs and the IASs. And I'm going to be running you through that in a moment. The IFRSs and IASs. Okay, what I mean is the accounting standards. Now, this is going to be the fundamental issue that we need to understand when it comes to dealing with financial reporting. Your ability to understand financial reporting standards helps you a lot because potentially the financial reporting standard has 40 marks in the exam hall. 40, potentially 40. Now, we're going to have a dedicated question on the standards on their own. Then we'll have single entity financial statements, and we're going to be getting into that in a moment. So potentially the accounting standard to underscore 40% in the exam hall that we need to make sure we understand. That is why we have to spend time to really understand the accounting standards. The good news is that all the accounting standards have been covered and are available on the portal. So you can actually watch some of them ahead of me before we even come to do it in class. The truth of the matter is that I will not be able to cover all the standards in class. So you can start watching some of the standards on the portal on your own because time will not allow us to cover everything. Time will not allow us to cover everything because there are a lot of the standards that we have to be aware of generally. But we're going to be going through the standards for you to know exactly the standards that we need to know about. Now, let me expand a little bit on the accounting standards. Because this is 40 marks potentially coming in the exam hall, there are some key standards that we need to pay attention to in order for us to pass the exams. So before we enter the exam hall, do or die, whatever it is, whatever that is going to happen, you must ensure that you understand the following standards. 1, IAS 16, property, plant, and equipment. That is what I call the grandpapa of the standards. In other words, that is the mother of the standards. But this is the sweet spot. If you are learning IAS 16, please note the standards don't go alone. They are not islands. The standards are interconnected. For that reason, if you are learning IAS 16, it must go along with other standards that have relationship with IAS 16, like IAS 37, provisions, contingent liabilities, contingent assets. IAS 40, investment property. Investment property. Like IAS 20, government grants. Like IFRS 15, non-current assets held for sale and discontinued. IFRS 5, sorry, held for sale and discontinued operation. Held for sale and discontinued operation. Discontinued operation. Like IAS 36, impairment of assets. All right. So when you're learning IAS 16, before you can say, oh, now, Charlie, IAS 16 there, I can kill it. I can kill it. Hey. Before you kill something, take it easy here. You need to understand the other standards that comes along with it. And then the last one that I think I'll bring up will be IAS 12, and that is going to be income tax. Income tax. Income tax. So the standards are not islands. The standards are not on their own. So if you are going to say you are learning the standards, if you start with IAS 16, make sure you know the encumbrances that IAS 16 has, the co-combines that IAS 16 has, because IAS 16 does not work alone. Now, for your information, IAS 12 is one of the basic standards as well. So even though it has a connection with IAS 16, on its own, it is there. Whether you like it or not, there is something about tax that will be in the exam hall. Whether you like it or you don't like it, there is something about it that will be, that you will need. So you want to make sure that you really understand income tax, not because it is just connected with the IAS 16, but also because it is a standard that is basic, fundamental for your examination. So that is IAS 16. So IAS 16 goes with the other standards. So you have to learn them together. And when I'm teaching you, that is the same way I'm going to be doing. Definitely, I'm going to cover all these standards you see here. And the way I'm going to teach it, you're going to love it. You're going to love it. And that is something that is very basic, that is very crucial, that we need to understand when it comes to dealing with the issue about that. Let's see. Someone coming up. Okay. Then we go to the second one, number 2. The second, okay, I'm seeing a chat coming in on Zoom. Let me take that already. Oxford said IFRS 16. Yeah, I want to talk about IFRS 16 on its own. Even though it has a connection, I'll talk about it on its own. Then IFRS 15, revenue from contract with customers. Revenue from contract with customers. Another fundamental standard you need to understand in order for you to actually put yourself in the spot to be able to pass the examination. So IFRS 15 is one of the standards that is going to be basic that you must know about. Then my personal favorite, which will also be your favorite, I know you're going to like this guy, IFRS 9, financial instruments. Everything that is my favorite, it's really simple to understand and lovely, because I only love simple and lovely things. Don't get any ideas. So IFRS 9, financial instruments, it's basic. It is basic. There is a 99.9% chance that there will be a footnote about IFRS 9, or there will be a question about IFRS 9 in your exam hall. So it is one of the fundamental go-to standards that you need to make sure you know about. Now, the reason I'm giving you some of these things is, for instance, what it means is that you could start watching those videos on the portal. Are you getting it? Using the April 2022 lectures, you will see, you could watch these videos on the portal so that you set yourself up even before it is treated in class. That way, you're going to be good. You're going to be good. So these are what I call the fundamental standards. Then we definitely have what Oxbert mentioned, IFRS 16 leases. So now leases is another standard. It's not a fundamental standard like always, but it's one of the standards you need to know about though. Just that it's not a fundamental standard that, I mean, it's a go-to. But when we say the go-to standards, these are the go-to standards that you must know about. The upper layer are the go-to standards that you must know about. Oh, Nhyira, it's a lot too. Don't get some ideas into your head. It's not a lot. It's not a lot. It's small. So how these plenty things, how are we going to learn it? Now you will learn it. Who should learn it for you? You got to learn it. Okay, you got to learn it. And the fun part is that they are not difficult. They are intertwined. They are interrelated. So the knowledge from one can be applied in the other. The knowledge, when you are learning one, the other comes in. And sometimes you can apply 3 standards in a footnote. So in dealing with one question, you need to apply 3 standards or sometimes 4 standards. And that is very crucial. Okay, that is very crucial. So these are fundamental standards, go-to standards in order for you to position yourself to pass the examination ultimately. But that is not all. In case you think that is all, I'm sorry for you, because there are other standards that we need to know about. Now, that doesn't mean these standards are not important, but there are other standards that we need to know about, and that is IAS 33, earnings per share. It's a basic standard. You need to ensure that you know about it well. Then I'm seeing a chart coming up. Let me see. Is IFRS different from IAS? No. IFRSs are newly issued standards that are coming out, and sometimes they are issued to replace old standards. So previously, all standards were IAS. So like, for instance, we had IAS 17, IAS 18. Now, IAS 17 was on leases. Because of the deficiencies that it has, they have released, a friend is saying, they have issued a new standard that is called IFRS 16. So the purpose of the IFRS is they are the new standards that are being issued to sort of bring the standards in line with the United States accounting standards. You know, for some reason, United States, they don't adopt international things. They have their own world. So what the International Accounting Standard Board is trying to do is that they want to bring uniformity and harmonization in their accounting standards when it comes to America and when it comes to Europe and the rest of the world. So because of that, these new standards are being issued and they are called the IFRSs, and they are there to either handle something that was not previously there or replace a previous standard that has some deficiency. So IFRS 16 is a new standard that is replacing IAS 17. And then IFRS 15, revenue from contract with customers, is also a new standard that is replacing the old IAS 18. So Eric Apia, if you ask, there are no difference. They are the same thing. The IFRSs are new standards that are being issued to replace old standard or to bring in new standard about things that were not existing. But the purpose of them is to bring harmonization between the International Accounting Standard Board standards with the standards of the United States of America, to bring harmonization in global preparation of financial statements. Eric, let me know if that makes sense for you. Timothy said, 33, hope to like it this time. Okay, yeah, I'm hoping that you like it this time. I don't know. That means you didn't like it previously. I don't know. So that is there about that. Eric, let me know if that makes sense for you. Okay, well understood. All right. So IAS 33 earnings per share will come in. Then we also going to be having IAS 38. That's going to be intangible assets. Actually, intangible assets is one of the basic standards because you're going to be needing it in consolidated financial statements. So it's, even though I'm putting in other standards, it's actually one of the standards that are there for us to know about in that particular case. So it's very critical for us to look at that. So IAS 33, IAS 38, we need to know about them as well. And then we go back to IAS 2, inventory. IAS 8, accounting policies, changes in accounting estimates and errors. And IAS 10, events after the reporting period. It's a lot. And for those of you who have my book on financial reporting, you will see that we explain all these standards with practical questions, and they are self-understood, even just by reading the books. And that is the purpose of the book, to make it simple for you, that you read, you solve questions, then boom, the clarity comes in. So these are also other, small little boy standards that we need to make sure to understand in that case. So generally, can we count? I don't like counting though, but 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. Yeah, there are other ones. I mean, there are, I think, 2 or 3 more, but I'll talk about them later on. You need, in the exam hall, you need to have knowledge between 6 or 8 of the standards will be applicable in the exam hall. Between 6 or 8 of the standards will be applicable. So the tall list that I've put down here, or put up here, that 40 marks that is coming in on the standards relating to specific question on the standard, relating to single entity financial statements, 6 or 8 of these standards will be that 40 marks. Now we know that, I mean, IAS 16, we don't do anything about it. It's going to be there. That one is checked. So that one is a done deal. Some way, somehow, IAS 16 will be there. IAS 12, some way, somehow, he's going to be there. So these 2 standards, they, like, we've marked them as fundamental. So before we go to the exam hall, like, we should know about them. All right, we should know about them. But the other ones that we cannot tell, but that is where we need to go through the standards, practice a couple of questions to ensure that we put ourselves in the position to be able to ultimately pass the examination. So that is the third, did I say third? Fourth aspect of the financial reporting syllabus that we need to understand in that particular case, the IFRSs. The IFRSs. Then the last one, number 5. Now, single entity is there, but I've captured it here. Single entity is where you are preparing either the statement of profit or loss, or statement of financial position, or the cash flow statement. One of them will be there. Okay, one of them will be there. The last one is consolidated financial statements. Consolidated financial statements. So consolidated financial statement, 20 marks, done deal, waiting for us in the exam hall. Done deal, waiting for us in the exam hall. So that is question 1. Okay, so question 1, that is consolidated financial statements. And that is going to be there. But there are a number of standards that are also basic when it comes to dealing with consolidated financial statements. And that is going to be the issue about IAS 27. We have IFRS 10. We have IFRS 3. We have IAS 28. Okay, so these standards are going to be the fundamental standards that will describe how we deal with consolidated financial statements. And when we get there, we're going to be referring to them and seeing how they are going to be dealt with in that case. So basically, when we talk about financial reporting, that's how the syllabus is. That's all. That's all about the syllabus. That's all about the syllabus. Now, there are other introductory issues Okay, there are other introductory issues that you must know about. The truth of them is that I may not go into them, but because you are supposed to read them on your own for now. Maybe later on when we are solving questions during the Saturday, Sunday sessions, we could go through them. But those introductory issues, I would want you to read them on your own. And for those of you with the book, you'll be able to read those simply. And these introductory issues include things such as uses of financial statements, then also the issue relating to standard setting, procedure. All these are available in the book, or it's not procedure, maybe it's process rather. The standard setting process. These are fundamental issues that you need to make sure you understand. I won't teach them, but you can read on them in whatever FR book you are having, whether my book or whatever FR book you are having. These things should be there, and you can just kind of read them and you go away. So in the next 12 weeks, these are the things that we are going to be going through. Any questions, please? Any clarity that you want, or you have anything to share with me? You raise your hand, I bring you up, or you put it in the chat for me, and I'll provide you with some answers as we get excited with our discussion. Okay, so let's begin the journey. Our discussion today will start with the issue about the conceptual framework, and I'm going to expand on there, and then we may conclude on ethics today. So today's discussion will be starting with conceptual framework, and then we will jump over straight into the how do we call it? The ethics. Okay, so that's how we're going to be starting our journey in that case. So conceptual framework. Conceptual framework. Now, in a simple language, as a financial reporting student, the first thing that you need to have in your mind at the end of the day is the issue about the conceptual framework. Now, in a simple, sometimes it is pretty hard for us to define what a conceptual framework is, but we definitely have an idea about what it actually entails and what it covers. So we're going to be starting our journey. Let me bring in my slide from here quickly. And that is from the book. Those with the book on page 11, you'll be able to find this there. I'm referring to it there, so we can pick it up from there straight up. Then I'm going to dive from there into our discussion. Okay, so those with the book, page 11, you can go along with me as we go straight up into our discussion. So the conceptual framework for general purpose financial statements states generally the accounting rules, that is the general purpose accounting principles that guides the way financial statements are required to be prepared by an entity. So among other things, the conceptual framework tells us a couple of issues that we need to understand when it comes to dealing with financial statements generally. So we want to start the journey with a number of things that we need to understand and a number of issues that we need to pay attention to. So just one-liner definition, like I said, these things are fundamental issues. So you need to understand them as a financial reporting student, but not necessarily that maybe the examiner will bring a question about it for you to ask, for you to answer, but you need to understand them to set the tone at the end of the day. Now, so we say that the International Accounting Standard Board, okay, the International Accounting Standard Board framework, that is the conceptual framework, Now, time will not allow me to take you through the regulatory organizations for financial reporting. Those with the book, you will see that in one of the chapters, we look at all the regulatory authorities that you must know about. As I teach you the various topics, I'm going to be mentioning them, but the list of all the regulatory authorities can be identified in the book later on for those of you who have the book. So the International Accounting Standard Board, that is IASB framework, provides the underlying rules, conventions, and definitions, underlying rules, conventions, and definitions that underpin the preparation of all financial statements, under International Financial Reporting Standards, IFRSs, under the International Financial Reporting Standards. So that is the starting point. The purpose of the conceptual framework is to provide us with what? The rules, the conventions, the definitions that underlie the preparation and presentation of financial statements. In other words, management, preparers of financial statements, how should they prepare the financial statements? What should be the guiding rule? What should be their point of reference? The conceptual framework is the point of reference that sets out the rules, the conventions, the practices that are required in order for management and preparers of financial statements to prepare their financial statements. Okay, to prepare their financial statements. But there are a couple of elements in the conceptual framework that we need to be aware of, that we need to pay attention to. The conceptual framework first tells us about the objectives of financial statements. I'm going to be getting into that in a moment. So it tells us about the objectives of financial statements. Not only that, it tells us about the issues in relation to the elements of financial statements. Not only that, we are also told about the qualitative characteristics of financial statements. Then also we are told about the underlying assumptions for the preparation of financial statements. Now, there are other things, but these four are crucial to set the tone for us to begin our journey. So what are we saying? We are saying that the conceptual framework provides us with the underlying rules, underlying conventions, underlying definitions that underpins the preparation of the financial statements. And the conceptual framework tells us about the objectives of financial statements. The conceptual framework tells us about the elements in the financial statement, their definition. The conceptual framework also tells us the measurement basis. Let me bring that up. I nearly would have forgotten that. So let me shift this down a little bit. And let me put measurement basis here. Don't worry if you have written it, you can put it at the bottom. I can move my thing, so you can put it at the last one. It doesn't matter. We will take them, so don't worry. So that is what the financial statement tells us, or the conceptual framework tells us. So each of these elements are crucial. They set the tone. We need to understand them even before we get excited about doing anything in financial reporting, about doing anything in the financial reporting. Now, please, in case you have any question or there is something you don't understand, you raise your hand, I bring you up, or you put it in the chat for me, okay? So When you raise your hand, I will just know, and then I bring you up, or you can put it in the chat for me, so you don't have to wait till whatever before you ask your questions. I want you to make sure you move with me and stay with me alongside. So let's go. In dealing with, okay, so I'm seeing a chat coming up. Timothy said, Nhyira, please, can you also say that the conceptual framework is the framework which seek to prescribe the nature, functions, and limits of financial accounting and financial statements? The nature, functions, and limits of financial statements. Yeah, to some extent, you can say that. Yeah, to some extent, you can say that. You can say that. To some extent, you can say that. Okay, so let's go about that. Now, before we begin the journey to find out about the objectives of financial statement and all that, we need to, okay, so I'm seeing another chat coming up. Okay, you're welcome. We need to first define what a reporting entity is, because everything we are going to be doing will be in relation to an entity. So we need to have a one-liner understanding of what a reporting entity is. Okay, so when we say a reporting entity, it's simply the entities whose financial statement we are preparing. Okay, simple. Simple. It is simply the entity whose financial statement we are preparing. So one-liner definition, we say that reporting entity is the entity that is required, to prepare financial statements and does not necessarily have to be a legal entity. Okay, so any entity that is required to prepare financial statement is what? A reporting entity. But most importantly, a reporting entity does not necessarily has to be what? A legal entity, meaning like we've registered it. Why? Because we can prepare financial statement for divisions. We can prepare financial statement for branches. We can prepare financial statement for segments of a business. Are you getting it? And the principle under that is under IFRS 8, operating segment. That is not in your syllabus. That is for corporate reporting. So I'm just writing it for writing's sake, but operating segments. So IFRS 8 gives guidelines on how we can prepare a set of financial statement for a branch, a division, or a segment of a business, and how we can recognize them. So what we are saying here is that the entity whose financial statement we are preparing is not necessarily going to be a legal entity, like separately on its own, but it's just going to be an organization and who is preparing financial statement generally in that particular case. So that is what we mean by reporting entity. So if we have to prepare financial statement for the reporting entities, then the question we ask ourselves is, hey, what set of financial statements must we prepare? And if we prepare them, what are the objectives of the financial statement? What do we seek to achieve when we prepare each of the financial statements that the reporting entity is required to prepare? And that brings us to IAS 1, presentation of financial statements. Presentation of financial statements. Presentation of financial statements. Now, according to IAS 1, presentation of financial statements, an entity is required to prepare the following financial statements. Okay, so a reporting entity is required to prepare the following financial statements. So 1, statement of profit or loss and other comprehensive income. Statement of profit or loss and other comprehensive income. Please let me know in case you sense I'm rushing. You indicate. Let me know if you sense I'm rushing. Okay. I don't know. I'm moving at the pace I think that would be good. But in case you smell I'm rushing, you catch me, okay? Because sometimes I get excited and I don't know. I could be rushing. So in case you sense that, you just let me know. Then he said, hey, Nhyira, take it easy. Then I'm going to take it easy on you. So please notify me in case you sense I'm rushing. So statement of profit or loss and other comprehensive, other comprehensive income. It is also known as the income statement. It is also known as the income statement. That is the first financial statement an entity is required to prepare. Number 2, the statement of changes in equity. Statement of changes in equity. Number 3, statement of financial position. This was OG. The OG people, they know it as the balance sheet. Now we don't call it a balance sheet. It is called the statement of financial position. Okay, so the word balance sheet is outmoded. Okay, so now we say statement of financial position, but it's the balance sheet, you know. Number 4, the statement of cash flow. The statement of cash flow. Number 5, statement of comparatives. I'm going to explain that to you. And then number 6, the notes. The notes to the financial statements. So the notes is part of the financial statements. So according to IAS 1, presentation of financial statements, these are the sets of financial statements a reporting entity is required to prepare. These are the sets of financial statements a reporting entity is required to prepare. Now, the big question we are asking ourselves from the conceptual framework is, what are the objectives of these financial statements? So if we are preparing the income statement, what are we looking at? When we're preparing the statement of financial position, what the heck is that? When we're preparing the cash flow statement, what are we saying? If you are looking at the notes to the financial statement, what is the objective? That is the first item in the conceptual framework, the objectives of financial statements. So to answer the question on what the objectives of the financial statements are, we have it here. So I'm going to just refer it to here in my slide. So the statement of profit or loss and OCI can also be called a statement of financial performance. Okay. And as the name suggests, it simply tells us the issue in relation to assessing the financial performance of an entity for the year under what? Consideration. Assessing the statement, the financial performance for the entity for the year under consideration. In other words, how much revenue did we raise during the period? Okay, how much revenue came in and how much expenses did we incur, and what is our profit or loss? So it talks about revenue, talks about our expenses, then what is our profit or loss? That is the purpose, that is the objective. Then this is not what I'm looking for. This one. So it tells us about the revenue, tells us about the expenses, it tells us about what? The profit or loss. That is what the statement of financial performance does. Now, the statement of changes in equity tells us about the movement in the capital of the shareholders. So the statement of changes in equity tells us about movement in the shareholders fund. Simple language. Tells us about the movement in the shareholders fund. Movement in shareholders fund. Now, we will talk about shareholders fund later, but when we talk about shareholders fund, we mean the following. Shareholders fund will be made up of the share capital, share premium, retained earnings, revaluation reserves, other components of equity. All these are what make up the shareholders fund. And so to determine the movement, how much was there at the beginning, how much is now there at the end of the year, the shareholders fund tells us that. And the way we know the movement of that is done in the statement of changes in equity. Then we come to the statement of financial position. The statement of financial position, as the name suggests, tells us about the statement of financial position of the company. In other words, we're able to know the assets that the entity has, the reporting entity has. We will know about the liabilities of the reporting entities at the end of the day for the period under review, so that we can determine, do we have a lot of assets or we don't have a lot of assets, and what can we do as a company to increase our profitability generally at the end of the day. So that is the statement of financial position. Now, the statement of cash flow, on the other hand, tells us about the cash inflows during the year and the cash outflows. In other words, how much money did we actually receive? Because you see, in the statement of financial position, we are going to be using the accrual basis of accounting. I'm going to explain that to you in a moment, which means we will recognize revenue, not when we'll recognize revenue when we have satisfied the performance obligation in accordance with IFRS 15. But the fact that you are recognizing revenue and income, that doesn't mean the money has actually been received. So we want to find out how much money did we actually get during the year, and how much did we pay out in terms of repayment of loan, in terms of acquisition of assets, in terms of repurchases of shares, in terms of leasing assets. Like, how much did we actually spend out? Okay, that is what we try to look out for in the cash flow statements. Then the statement of comparatives has to do with where we are preparing a statement for a reporting entity for, say, 2 or more years, so that we will compare to see the growth that is coming in. And the statement of comparative will be prepared for the statement of profit or loss, will be prepared for the statement of financial position. So this is where we prepare the financial statement in a columnar form. So you see 20x2, 20x3, 20x4, 20x5. Then you see revenue for all these years, cost of sales for all these years. All these are what we refer to as the statement of comparatives. And hardly will we have that coming in that particular case. There is one, which is also in your syllabus. I'm going to talk about it pretty later on. It's called the value added statements. Let me just add that here. We'll talk about it pretty later on. Value-added statements. It's in your syllabus one way or the other. So it's something that I will share my thoughts on briefly. And there is a video on the portal also about value-added statements that you can know about. Now, the notes to the financial statements is the notes. So this is where the various disclosure requirements are done. So the notes to the financial statements are for disclosure purposes. Okay, they are for disclosure purposes. So the various disclosures that we are going to do as an entity will be done in the notes to the financial statement. So in accordance with IAS 1, presentation of financial statements, these are the financial statements that a reporting entity is required to prepare and submit to the company or to the users of the financial statements. Any questions, please? Any questions? Any questions? You raise your hand, I bring you up, or you put it in the chat for me, and I'm going to be replying to that as well. Okay, so that is the first thing. But then these financial statements, when they are prepared, they must be used. So that is where users of financial statements comes in. Like I said, I'm not going to share my thought on that, but users of financial statements. Shareholders are users. You must know the reason why they need a financial statement. Management are also users of their own financial statement. You must know the reason. Employees are also users of financial statement. They need a financial statement for salary negotiation, demanding of work benefits and all that at the end of the day. Right now in Ghana, for instance, what you are seeing is that various labor unions are coming in to request for better salaries and all that. And you are like, why the heck are they now demanding better salary? Because, for instance, they have seen the financial statements of Ghana and they see the money that is coming to the government and they see what the government is spending the money on. So if the government is getting a lot of these money and the government is spending the money on certain things, then they should give us better employment services. The same thing happens in the private sector. When employees look at the financial statement, they are like, we are making a lot of profit. Why the hell can't you increase our salary a little bit? Why the hell can't you give us a better working condition? So employees use the financial statements for salary negotiation and also to also be assured of job security, which is important because the financial statement inform you whether the company can operate into the foreseeable future, that is in the next 12 months, going concern. Are you getting it? So the employees need the financial statement. Our creditors need the financial statement, that is providers of finance. They need a financial statement for them to assess the credit worthiness of the company to determine whether the company can repay its debts or not, to determine if the company can repay its debts or not. So they need the financial statements. Are you getting it? Customers need a financial statement. Why? Because they also need a financial statement to determine whether this entity can be operating in the next foreseeable future or in the next 12 months, and that they can continue to buy their goods from the company or from the reporting entity in that particular case. Then our competitors, they also use our financial statements for their own decision making and all that. So users of financial statements, you can read on that later on, but these are some of the things that we need to understand. But if these are the financial statements we prepare, the big question then is, what are the elements in the financial statements? So when we prepare the financial statements, it should have some elements. So the question we then ask ourselves is, what are the elements in the financial statements? So let's look at elements in the financial statements. So elements in the financial statements. Basically, there are 5 elements in the financial statement on the fundamentally that we must know about. There are 5 elements in the financial statements fundamentally that we must know about. 5 elements. 5 elements. The first one is assets. We have liabilities. We have equity for number 3. We have equity. We have number 4, revenue or income. And we have number 5, expenses. We have number 5, expenses. Expenses. Okay. So what is an asset? What is a liability? What is equity? What is revenue? What is income in that particular case? Yes, any ideas? Someone should give me some definitions. What is an asset? Yes, Timothy, your hand is up.
Yeah, sure. Please, good evening.
Good evening.
Okay, an asset can be defined as a resource that the company or an entity control as a result of Okay, it's a resources that a company control as a
Right.
result of past events, which which is probable that the economic useful life or usage will flow into the entity.
Relax. Take it easy. Take it. The unse udi baba bisa na ushie gwa na
Well,
style.
it's not that, but I'm just
Okay,
recalling.
so relax. Take a deep breath and come again. So
Okay,
assets are
resources that an entity controls.
right.
Yeah.
Assets are resources that an entity control. Okay. Into where we now what they be account. Okay.
As a result of past events.
Okay. An entity controls as a result of past events. Okay.
Which is probable that future economic values will flow into the entity.
Okay. Fine. So let me just polish Timothy's definition up, then we look at it. So these are the resources an entity controls as a result of past events. Okay, if you want a standard long definition, as a result of past events from which, as a result of past events, the economic benefits of which flows to the entity. Note, the key word here is ebaze, control. That's the word. It is not something you own. It is control. Now, control means that the entity has the right to direct the usage of the asset. So if we have the right to direct the usage of the assets, it means we control the assets. Then two, control means that the economic benefit of the asset flows to the entity. Okay, significant future economic benefit flows to the entity. So when we say, oh, this is an asset of a company, it simply means they control it. It doesn't mean they own it. Okay, that is why, for instance, some of the banks that were, their licenses were revoked. I mean, some of them were in, luxurious facilities. And so people were like, wow, but they were in those facilities. Isn't it they are building? No, they leased it. It's leased. But on the face of their financial statements, they have recognized it in accordance with IFRS 16. So it's as though the asset is theirs, but it's not theirs. They don't own it. They just control it, meaning they direct the usage of the asset, and significantly, the future economic benefits, which means revenue from the usage of that asset, flows to the entity. Okay, so that is assets. Now, there are various types of assets. We have tangible assets, intangible assets. We'll get into all that under the standards. So I'm not going to worry my head on that. But that is an asset. Please, this definition, make sure you know it. If you sleep and you wake up and your wife or your husband comes to you and say, hey, honey, what is an asset? If you don't say it, no breakfast for you. You should be able to say it. Do you understand? These are simple definitions. Okay, what else do I have? Who is picking something up? Yes, Oxbet.
Good evening.
Yeah, good evening.
Please, I want to make some clarification. Like, I've realized that they have changed the definition of the asset in the ICAG syllabus. Do we have to take into consideration when we are writing? Because,
like, change from what to what? Like, what's the definition you have?
Yes. So, for example, an asset previously we said is the resources that an entity controls as a result of past events,
right?
Of which the economic benefit of the asset flows through the entity in the future.
Quick network in here. Oh, sorry. Your network is not good. It's jumping.
Right. But it's like, can you hear me now? Hello?
Yeah, I can hear you. Give me the second part.
Yes. So The second part is like they said, an asset is a resource that an entity controls as a result of past event.
It ends there. That's all.
Yes.
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 So that is the definition, because you see, the issue about the last part, you see, I brought a comma here. The issue about this last part is not really something that we have to know, because if you control something, then the economic benefit is coming to you directly. Are you getting it? So that is why now when we are defining assets, we just stay with the first part, that they are resources controlled by an entity as a result of what? Past event, period. Because once you are controlling the thing, the economic benefit will flow to you. Does that make sense?
Yes.
Okay. All right. So any other, who else is taking some KG2 definitions for me, please? Well, what is the difference between revenue? Yes, Emmanuel and him.
So please, I'm taking liabilities.
Okay.
Okay, so I would say liabilities are present obligations as a result of past events,
Right.
for which there will be an outflow of resources from an entity or from the company.
Right. That is it about that. So liability is a present obligation. That means you are owing right now, okay, as a result of past events. As a result of past events. Again, based on the conceptual framework from a conceptual framework of the International Accounting Standard Board, like we can end the definition here. I get it. The settlement of which result into an outflow of future economic benefits to the entity and all that, I mean, could be there in that particular case. Could be there in that particular case. So that is the issue about that. But what is provisions? Because we can use liability and provisions interchange. No, sorry, we can't use it interchangeably. What is provisions? Make sure you don't tell me what I think you will tell me. What is provisions? Any ideas? There should be some ideas here. There should be some ideas here. Any ideas? Provisions. Yes, Timothy.
Yeah, sure. I think provision is future obligation.
Was three. Future obligation. Maybe boyum. Yes, future obligations.
Which is discounted now.
No, I don't like that definition, Timothy. I won't take that.
I don't know how to put it.
You see, bro, phone I want it. Yes, anybody else? Yes, Oxbet.
Yeah. So we said provisions are liabilities of uncertain amount which are expected to be paid in the near future.
Right. So when we say provision is simply a liability of uncertain amount and timing. Okay, you owe, all right, but you don't know how much you owe and when you are going to pay it. So you provide for it. I get it. And we'll explain that at IAS 37 later on. Okay, later on, and you will be able to see it. You'll be able to see it. So that is the second item there. Give me difference between, is revenue the same as income? Is it the same thing? You think so? Yes, what's the difference between revenue and income? Are they the same? I know everybody will say they are the same. Thanks be to God. Hooray. Let's clap for everybody. Yes, Oxbet.
Yeah, so revenue is the turnout we get from our core activities.
Okay.
Income
The what?
The turnout.
Okay. Okay. that we get from our core
activities.
Okay.
Whilst
Okay.
income is let me say what we gain or earn from selling or from our non-core activity.
Okay. All right. So when we talk about revenue,
Yeah, for example, selling an asset.
Okay, selling an asset. All right. So when we talk about inflow, income or revenue has to do with increase in economic benefits. Okay, increase in economic benefits. So an income is an increase in economic benefits. A revenue is an increase in economic benefits. I getting it? Only that, like Oxbert put it, revenue is increase in economic benefits coming from the core activities of the entity. Core or the primary activities of the entity. Are you getting it? So like for instance, if we are dealing with okay, Ernest in the chat is saying revenue are proceeds from core activities and income are proceeds from non-core activities. Yes, we can say that. So revenue and income are all increase in economic benefits. Okay, they are all increase in economic benefits. But revenue is from your core activities. So for instance, if you are a school, what is your core activity or what is your core source of revenue? Teaching. So school tuition fees becomes what? Your revenue. But then income will be an increase in economic benefit from non-core activities. Okay, from non-core activities. From non-core activities. So for instance, investment income. Maybe you have an investment somewhere. And so the investment income will be an income that you have at the end of the day. Reduction in liability is an income. Okay, reduction in liability. You owe somebody, and for some reason the liability has reduced. The person is dead, or the company goes bankrupt and they didn't come for the money from you. You write off the liability, and that becomes income in your book, and you do party for it. So reduction in a liability is what? An income in that particular case. Disposal of assets. Okay, profit on disposal of assets. Profit or on disposal is also an income coming in. Fair value gain. Okay, fair value gain. And we'll deal with this later on under IFRS 9. That's also an income. Are you getting it? So when we say income and revenue, they are all increase in economic benefits. But revenue is increased economic benefits from the core activities of a reporting entity, sorry. And then income is the increase in economic activities from what? Non-core activities of a reporting entity. Any questions, please? Everybody good on that? Everybody good on that? And there was a question by Sharon on, let's see. So is it wrong for you to say that the asset is owned and controlled as well? No, you cannot say the two like that, Sharon. You can't say the asset is owned and controlled. No, it's control. We don't own. We don't necessarily have to own an asset to report about it in our books. Okay, so the key word is control. And control can come from two sources. Either we are owning it or we are leasing it. Okay, either we are owning or we are leasing. So you can't say own and control. No, you can say just control by the entity. Okay. What else we got? Expenses. What is expenses? Expenses. Yes. Who is giving me KG2 definition? Let me see if I can give you Tom for the definition of expenses. Maybe I'll be Yes, Collins, come up. Let's see. Expenses.
Expense is the cost of generating revenue.
The cost of generating revenue. Okay, I love it. I love it. It's like Collins is giving us, the KG2 definition and say, hey, Nhyira, let's take it away and go. It refers to the cost of Generating revenue. Yes. Timothy, your hand is up. Let's see another definition there.
Expenses can be defined as the amount of expenditure incurred in an activity or process or
Oh, I dream
It's
money
not
about
right.
you. Oh, I dream
Okay.
money about you. You are actually
Why?
defining, you are trying to define a cost, right? So you are just
No.
flipping it up. in
No,
there. Okay.
I'm not.
So it refers to what? The amount of expenditure.
Incurred
Amount of expenditure incurred
in an activity.
in an activity or undertaking or a process, you know.
The settlement of which,
Hey, Nyantoba said, what the settlement of
like I'm trying to recollect it, but the way you're doing it, I have a minute.
Oh, that's the purpose of Baba. Udi Baba
No,
okay, so the settlement of which results into outflow of economic benefits. But you know, once you said it's an amount of expenditure we are incurring, there will be an outflow. Are you getting it? So we will just ignore the second part. So ignore the second part. Yeah, Oxbet, you want to give me some apophy and I say apapa?
Yeah. So liability expenses are simply an increase in liability or reduction in revenue.
Increase in liability
Or reduction in revenue.
Okay.
Or income.
Or reduction in income. Okay. Okay. Reduction in income. All right, that's fine. Thank you. Now, in actual sense, you've all said something from Collins to Timothy to Oxford. You've all said something. That is all expenses is about. But in a simple language, as per the conceptual framework, we could say that expenses refers to the reduction in the economic benefits of a reporting entity. The reduction in the economic benefits of a reporting entity. That is an expense in a simple language, okay? Now, everything he said is the same thing. Everything he said is the same thing. So for instance, Collins's definition, cost of operation, okay? So wages and salary, okay? Expenses or wages and salary cost, that is expenses there. But also increase in provision is an expenses. Okay, increase in provision is an expenses. It's an expenses, okay? Now, remember I told you increase in provision or increase in liability. Remember a reduction in liability, I told you is an income a moment ago, right? Reduction in liability is an income. So increase in liability is actually what? An expense as well, okay? Then issues about impairments of assets is an expense. Impairment of assets is an expense. Okay, when your inventories are written down, we will look at all of these later on. It's an expense in that case, and we have to know about that as well. So when we say expense, we mean what? A reduction in the economic benefits. All of these things reduces the economic benefits, how much cash that an entity has. Bad debt is an expense. Okay, people owe us, but they are not able to pay us, so we have to write them off. So that becomes an expenses as well in the books of the in the books of the reporting entity. So that is what we must understand when we talk about what? Expenses, okay? And all these can be captured around the three definitions that you guys gave earlier as well. Roger Kwame said, please, losses and expenses, there is difference. Is there, I think you're asking, is there a difference between losses and expenses? Yes, no, depending on where you are coming from. On one line, losses is an expenses. Okay, so loss is an expense. Okay, loss is an expense. Let me put it that way. Loss is an expense. But the reason I said yes and no is because of the context that you are coming in. For instance, and you will understand this later on when we are doing the standards, there is something under IFRS 15, revenue from contract with customers, that when we are undertaking a contract and the contract results into a loss, the standard says that that should be treated as onerous contract. For that reason, that loss should be written off as an expenses in the P&L account. So in that context, the loss becomes an expenses. I getting it? Then, for instance, if we have assets or inventory and there is a fire outbreak in our factory and we have to write off those inventories, now we've lost that. That can also become expenses. But then when you come from the context of preparation of the financial statements and we finish preparing the financial statements and we get a loss, that is net loss instead of profit, that is not an expenses technically. It will not be called expenses because it is a loss on the face of the financial statements. So yes or no, depending on where you are coming in from in that case. Kwame, let me know if that makes sense for you, Roger. Yes, Timothy, your hand is up.
Say,
Ma.
can you take the onerous contract again, the definition? Like, actually, I plan to ask you today, so as you mentioned, I'll just
okay, so what I said was that, for instance, let's say if under IFRS 15, when a performance obligation goes beyond one accounting year, what happens is that we have to calculate the profit or loss on the contract. So if you calculate the profit or loss on the contract and you realize that the contract results into a loss, IFRS 15 and IAS 38 requires that should be treated as an onerous contract. So that loss from the contract at the date that we did the recognition or we did the calculation should be written off as an expenses in the P&L account. If the contract is a profit, that is where we will look at stage of completion using the input or output method to share it and prepare balance sheet for it. Does that make sense?
Yes, please. Thank you.
Right. Bra Collins.
Sister Nhyira, so so to add to Timothy's question, so and your explanation, does that mean that, for example, the contract ends up in a loss? Does that mean that you are going to recognize the total value of the contract? You write it off?
No, we are writing off that loss because, for instance, this is what we mean. We will bring the contract value. Okay. So let's say whatever the contract value is 100,000. Then total contract cost, how much cost we incur is 120,000. So it means of the records, this is a loss coming in. The contract is a loss of 20,000. This 20,000 is what we are treating as expenses in the P&L accounts. Does that make sense?
Yeah, got it.
Yes, that is what we are doing.
Okay.
Okay. Roger said, thank you, sir. Okay, you're welcome. So that's about expenses. Okay, so we're going to expand on this later on when we are doing the standards, we are doing the financial statement. So anytime you hear about, if you hear me making the statement, write it off in the P&L account. Write it off in the P&L account. Write it off in the P&L account. And I'm going to making this statement a lot when we are doing the standards and single entity. Write it off in the P&L account. When I say write it off in the P&L account, it means that thing becomes what? An expenses. It means that thing becomes an expenses. All right. Then certainly we have a last one, equity. I mean, we don't need a miracle on equity. You know equity already. Equity is the residual value of assets after liability. Okay. Equity is the residual value of assets minus liability. That's all. The residual amount after all liabilities is paid from assets. It is from this concept that we have what we call the accounting equation, which says that assets should be equal to equity plus liability. Asset is equal to equity plus liability. And when we are preparing the statement of financial position, this will be the knowledge base that we're going to be using for the preparation of the financial position. Any questions, please? That is the first part, elements of financial statements. Everybody good on that? Any questions for me? Okay. So we've looked at the, yes, Timothy?
Please, are we going to talk about I want to ask if the equity one, it has any recognition criteria?
Hey, why? Your big head. We will look at that later on in the discussion, like in the course of our discussion. There are amounts that should be recognized as equity. We will treat them individually later on. When a company issues shares, how should it be recognized? In accordance with IFRS 9, we will deal with it later on, and all that. When a company revalue assets in accordance with IAS 16, the revaluation surplus, it's part of equity. How should it be recognized? So we'll get into that later on in the discussion when we talk about the standards and we are dealing with all that. Now let's go to the next item, that is measurement basis. Please, in case you've not taken anything serious in the last 1 hour, 40 minutes, what I'm about to explain and discuss with you will set the tone for the entire financial reporting exams. And that is called measurement basis. When you screw it up, you are screwed up forever. So make sure you are not screwed up. So measurement basis. Now, the elements in the financial statement must be measured. They must be recognized. So before we get excited about it, there are 3 things I want to talk to you about for us to expand our knowledge. First, I want to talk to you about is recognition. You're going to be hearing us using or making this statement a lot, recognition. So what is recognition? What is recognition? In a one-liner definition, we say that it refers to the process of including an item in the financial statements, the process of including an item in the financial statements, and is appropriate if it results in relevance and faithful representation. Relevant and faithful representation. Now stay with me carefully here. So when we say recognize something, what do we mean? We mean incorporate it in the book. We mean include it in the financial statement. That is what we mean by recognition. The process of including an item in the financial statement. Are you getting it? That is recognition. So when we say, oh, this will be recognized in the P&L accounts, this will be recognized in the statement of financial position. When we say this will be recognized in the cash flow statement, this will be recognized in the statement of changes in equity. So when we say, oh, recognize it here, it means include it here. It means incorporate it here. Now, the flip side of that is derecognition. That's the opposite. Derecognition. Derecognition. So what the heck is derecognition also? Derecognition is the removal of all or part of an item in the financial statements. So it refers to the removal the removal of all or parts of an item in the financial statement. So when we say derecognize something, it means remove it from the financial statement. It means we don't want to see it again in the financial statement. It means don't tell us anything about it in the financial statement. That is what we mean by derecognition. But this is where the journey becomes interesting. If you are going to incorporate something in the financial statements or remove something from the financial statements, it has to be measured. It must have an amount. There should be a figure that you placed on it. So the question we ask ourselves is, what is measurement basis? Measurement basis. So when we say measurements, what the heck? No, let me define measurements before we come to measurement basis. Sorry. Let me define measurement before we come to measurement basis. So in financial reporting, when we say you are measuring something, it doesn't mean you go and pick gallon and start measuring, or it doesn't mean you go and pick, some test tube and start measuring at something. You're not in a chemistry class. You are an accountant. So when we say we are measuring something, it refers to the process of the determination, refers to the process of the determination of the amount at which an item is carried in the financial statements. It's carried in the financial statements. That is what we mean by measurement. Simply, it is about what? Determination of the amount. So that's the takeaway I want you to have. When you hear measurement, it means we are determining the amount at which something is supposed to be carried. We are determining the amount at which something is supposed to be carried. Does that make sense, please? Any questions? If you have any questions, you raise your hand, I bring you up, or you drop it in the chat for me. So these are the three things I want you to understand. And we're going to be using them a lot in the rest of the next 12 weeks. And you're going to be using it as far as you're going to be practicing accounting, recognition, derecognition, and measurement. But this is where the big question comes in. What is the measurement basis? What are the various ways that the amount of something can be determined? What are the ways through which the amount of something can be determined? So let's look at the measurement basis. Measurement basis. So when it comes to dealing with measurement basis, there are a number of measurement bases that we need to know about in that case, and we need to share our thoughts on for us to know what it is we need to do in that case. I'm seeing some chats coming on YouTube. Let me see if I can just look at them real quick, then we continue. Let's see. Mandy Q said, hi, please, will this class be held every Friday? Yes, but not on, it will not be available on YouTube every Friday. If you want to join our main class, you can call or WhatsApp us 05011499296 and enroll in our full course so you can join our Zoom session. So, but FR will be held on Fridays, but will not be available on YouTube always like you are seeing today. Music on YouTube said, I'm doing ACCF 7 soon, but I'm afraid to book my exams because it is like I'm not really prepared. Your advice, please. Yeah, if you're not prepared, you have to be prepared and you must study. So YouTube, some music on YouTube. If you have not booked because you are afraid, it means you are not prepared. So don't book. Probably go to September or December and take time to study. I will encourage you to attend the lectures Because if you attend lectures, you are given the guidelines and you can reduce the fear a little bit to an acceptably low level. So if you're not ready and you are scared, it means you don't have a lot in your head and you don't have a lot in your memory. So please don't do it. Attend lectures and make sure you do well in that case. Joshua Prince Amo said, hello, Nhyira, watching you live from Germany, studying my master's in MBA Financial Management. Your tutorials has helped me in my international accounting class where I even didn't understand my professor. Okay, thanks very much, Joshua. Fedra said, please, what does it mean if an examiner states, assume the tax written down value is of a company's asset is equal to the carrying amount? Okay, so when that statement is made, that assume the tax written down value is equal to the carrying amount, this statement comes in if you're dealing with IAS 12. It simply means that the tax base of the asset is the same as the carrying amounts. So it means there is no temporary difference. Okay, so if the examiner says the tax written down value is the same as the carrying amount, it means the tax base of the asset is the same as the carrying value. So there is no temporary difference. So the temporary difference in this question is nil. In that case, there will not be any deferred tax. So there will be no deferred tax. That's the meaning of that statement. Mandy Q said, sorry, I didn't join early, but which portal are you talking about, please? We are talking about our online portal, NhyiraPremium.com. You can see the link in the description of this video, or you can download the Nhyira Premium mobile application on the Google Play Store or the App Store. Joseph said, feedback of another class is interfering with the F4 class lecture, please. Okay. Then Bila Christopher said, good evening, good evening. Good evening, Nhyira. I just joined today's lecture. How will I get the full lecture? You can enroll in our full courses online. You can check the description of this video and you can get a link. It's 390 Ghana cedis per paper, and you can enroll and join our full lectures in that case. Okay, that's it. Let me go back to my learning. Daki said, please, can we also say to determine the cost of an item? Okay, are you referring to measurement basis, Daki? I think that is what you are talking about, the measurement. The cost of an item. Yeah, yes, we can say that. But when you say that it is below, it doesn't cover everything. So instead, if you use the amount of something, then it will be appropriate. But you can say the cost in one spirit in that particular regard. So yes, Daki, you can say that. Okay, so let's look at the basis of measurements real quick. So when we say measurement basis, I mean, broadly, they can be divided into two. Okay. So we have measurement basis based on historical cost. So you're going to hear me mentioning this a lot. Oh, carry the item at its historical cost or current value. So it is either we are measuring the item and carrying it at the historical cost, or we are carrying it at the current value. We're going to explain that for you to understand exactly what is going on. Now, when we say the historical cost, we mean that the price of the transaction, that gave rise, the price of the transaction that gave rise to the item. In other words, that is the initial value. I'm seeing a chart coming in again. Okay, well noted. All right. So when we say historical cost, we are saying the price of the transaction that gave rise to the item. So for instance, if a company buys an asset, okay, and they purchase the asset for $10 million, that $10 million becomes what? The historical cost of the assets. Okay, so the price of the transaction that gave rise to the item is the historical cost. Like the initial cost you incurred or the initial value of the item becomes the historical cost. The initial measurement of the item becomes the historical cost. So if I bought an asset at $10 million, that becomes the historical cost because that is the initial value coming in a particular case. So that is the first thing we must understand, historical cost. Historical cost. Okay. Then we come to current value. When we talk about current value, we are looking at the fact that the current value provides. So those provide updated information. This provide updated information to reflect conditions at the measurement date. Conditions at the measurement date. Conditions at the measurement date. Now stay with me carefully. Stay with me carefully. So under current value, what we are doing here is that we are not looking at the price that gave rise to the item. We are looking at some other information about the item. Then we use those information to place a value on the item. Does that make sense? Let me take that again. Whilst the historical cost, we will look at the price we paid for or the cost we incurred in acquiring the item, the price that gave rise to the item. Under current value, we are looking at current available information which sets the pace and assists us in order to now place a value on the item that we are measuring. So under this, we have some other guys, and that is called fair value. So the first one under current value is fair value. So we have fair value, we have value in use, and we have the replacement cost. So let me share some thoughts with you real quick under these. What is fair value? When we say the fair value of an item, what the heck do we mean? When we say value in use, what the heck is that? When we say replacement cost, what the heck is that? So one-liner definitions, and then let's jump over. So fair value. So when we say fair value, it refers to the value at which an asset can be exchanged or a liability settled in an arm's length transaction between market participants. So let's take that. Let's put that down. So it refers to the value at which an asset can be exchanged or a liability settled in an arm's length transaction between knowledgeable. I know I've made a definition very long though. Between knowledgeable parties. So how much can we get if we are selling our assets? That is the fair value. Okay, that is the fair value. That is the fair value. That is the fair value. Now, there is another one there called realizable value. I'm going to explain that to you also in a moment, but that is the fair value. Sorry, that is the fair value. Then we have the value in use. Just listen to the name, value in use. Value in use. This is the value that we will get from the continuous usage of the assets. So it refers to refers to the expected economic benefit, from the usage of an asset. So if we don't want to sell it, we want to still use it, what will be the benefit we will get from this asset in the remaining useful life of the assets? And we'll explain this later on under IAS 36 when we are dealing with impairment. I'll explain that later on. And I'll explain that alongside with value, realizable value later on. So there is also a concept about realizable value, or what we call net realizable value. Let me shift this a little bit so that I can have the net coming in. Net realizable value. So when we say net realizable value, it is simply the fair value less cost to sell. In other words, fair value minus cost to sell. And it is one of the terminologies we're going to be using as well. So fair value is how much can we sell the asset for? How much can we sell the inventory for? Okay. Net realizable value is, when you're selling something, you will incur cost to sell it. Okay. Agent's commission. Okay, the agent who facilitated the sales, you have to pay the person. That is cost to sell. Maybe the thing is faulty and you have to do some maintenance on it. That is part of cost to sell. Maybe the thing is somewhere that you would have to uninstall it before you sell it. The cost of uninstallation will be part of the cost to sell. So if we take care of all those expenses necessary to make the asset sellable, or to put the asset in a sellable condition, when we take all that information, how much will we be left with as a company? How much will we be left with as a company? Give me a moment. Let me see. Okay, so that is net realizable value. Okay, again, we'll deal with that later on. It is applicable in inventory. It is applicable in IFRS 15. You will use this in IAS 2. You use this in IFRS 15 as, did I say 15? Sorry, IFRS 5 as well. And you may use it across other standards, but these are the two fundamental standards that we need to look out for in that particular case. So fair value, value in use, net realizable value. Then there is a third one there, replacement cost, which, because I'm putting net realizable value here, I'm going to bring that up. Replacement cost. As the name suggests, replacement cost, it refers to the expected cost to be incurred to replace the assets. Are you getting it? That is the idea about that. So it refers to the current cost expected to incur to acquire or replace an asset, to acquire or replace an existing asset. That is a replacement cost. So if 2 years ago we bought the asset for 10 million, if we want that same asset today, how much do we pay, or how much will we pay? If 2 years ago we paid 10 million, if we want to buy the same thing today, how much will we pay? That is a replacement cost. So generally, the measurement basis, we have the historical cost, then we have the current value. Then there is another one, which is present value. Sometimes we can measure an item using present value. So that is also another basis of valuation. And sometimes that can be put under the current value as well, even though it is supposed to be on its own in that case. So present value refers to, the discounting of the future cash flows on an item So that is present value. So you discount it. So the present value is equal to the future value times the discount factor. And we're going to be using this later on under IAS 16, under IAS 37, and sometimes under IFRS 10. That is when we are doing consolidated financial statements. We're going to be using the concept of present value. And then impairment of assets, IAS 36. When we are dealing with value in use, we have to discount the values into present terms. So we're going to be using this measurement basis as well in a number of principles later on. These are the measurement bases we need to know about. Any questions, please? Any questions? Okay, we're good. So that is the next item in our conceptual framework. Let's go back. So let's check the box. We've done the objectives of the financial statement. We've looked at the elements of the financial statements. We've looked at the measurement basis. Let's go to the qualitative characteristics generally of the financial statements. Qualitative characteristics of the financial statements. Qualitative characteristics of the financial statements. Now, when we talk about qualitative characteristics of financial statements, we are referring to the attributes that a set of financial statements must have in order for it to be useful to the users of the financial statements. Okay, so the qualitative characteristics refers to, so these refer to the key attributes that a set of financial statements must have to be useful to the users of the financial statements. To be useful to the users of the financial statements. That is qualitative characteristics. Keyword, key attributes. Key attributes. Key attributes. Now, the qualitative characteristic can broadly be divided into two. The qualitative characteristics can broadly be divided into two. The qualitative characteristics can broadly be divided into two. We have what we call fundamental qualitative characteristics. And then enhancing qualitative characteristics. In total, there are 6 of them. Okay, so in total, there are 6 of them that we must know about in total, but we're going to be looking at them in a moment. So fundamental qualitative characteristics, we have what we call relevance. We have what we call faithful representation. Then under the enhancing, we have what we call comparability. We have verifiability. We have timeliness and understandability. Now, why the distinction? I mean, they are all qualitative characteristics, but why the distinction? Why the need for us to distinguish between what is fundamental qualitative characteristics and what is enhancing qualitative characteristics? The distinction simply is that the fundamental are like the basic, the pillars. No matter what it is, even if you can't do comparability, even if you can't do verifiability, even if you not make it for us to understand, at least it should be relevant and it should be faithfully represented. So the fundamental are the pillars that holds the financial statements. But the pillars will require some other supporting levels for us to trust the financial statement. So the enhancing characteristics then completes the financial statements to make it understandable. But when we say the financial statement should be relevant, what the hell do we mean by that? When we say faithful representation, what is that? When we say comparability, what is that? When we say verifiability, what are we talking about? When we say timeliness, what do we mean? When we say understandability, what does that mean? Yes, any ideas? You raise your hand, I bring you up, or you put it in the chat for me. Let's share some thoughts on this quickly. What the heck are we talking about? What is relevance? What is faithful representation? What is what? Yes, Oxbet, what are you taking?
Yeah, so I'll tackle the faithful representation.
Okay.
Financial statement is said to have faithful representation if it is free from bias and is complete and also free from material errors.
Okay. Okay.
Then the relevance too has to do with where the inclusion and exclusion of if an information is likely to affect the understandability and the users of the financial information.
Okay. Okay. When the inclusion or exclusion of an item will be relevant or will affect the understanding of the financial statements. Okay. 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 All right. That'll be good there. Any other ideas? The almost can no. Configure. Share your thoughts. What they are saying, that is all. If you think I'm going to say anything again, and they wenya. And the wenya. Yes, Kofi. Come up, share your thoughts. Let's see. Anna, Kofi. Okay, yeah, Kofi, I'm listening.
Timeliness.
You want to take what? Timeliness. Okay, let's go.
This means that the accounting information should be provided at the right time when it is needed, because any delay or unnecessary delay may render the information useless and therefore lose its impact on the decision-making needs by users.
Excellent. I love it. I love it. I love it. That's all. No. Timeliness and no. Information should be provided when it is needed. And information that is provided too early is not useful. If it is provided too late, it's not useful. It should be provided as and when needed so that they can make decisions. That is why for listed companies, for instance, they are supposed to prepare quarterly financial statements. So every quarter, they are supposed to release financial statements. And the financial statement has to come out on a certain date within a certain period. If it doesn't, then they are likely to receive some sanctions from the Security and Exchange Commission of the stock exchange or something like that. So timeliness means the information must come as and when we need it, not just by the shareholders, but also by management, so they can make decisions on time. All right, thank you. Yes, Timothy, what you got?
All right, sir. Please, after please take the listen again, the enhancing and then the fundamental again. But I want to talk on comparability.
Right.
Okay, the shareholders or the users of the financial statement should be able to compare financial statement of an entity.
Hey, you
Say,
did grammar. You did grammar in school. You can't be defining things and bringing the thing you are defining inside. Should be able to compare.
Okay.
Okay. Yeah, we'll be able to compare. Okay, you go ahead.
Financial statement of an entity over time and with a similar entity in the same industry.
Okay.
And there must be a consistency and disclosure.
Okay. So comparability simply means that the financial statement should be prepared in such a manner that users can identify differences and similarities between entities and also year on year. Okay, that is what we mean by comparability. The financial statement should be prepared in such a manner that the users of the financial statement will be able to identify similarities and differences, okay, of the entity and also year on year. But for comparability to be possible, that is what you mentioned, there should be consistency. Consistency in what? Consistency in the application of accounting principles. Sorry, accounting policies. So comparability is only possible when there is consistency in the application of accounting policies. Does that make sense? That is comparability. Now, when we say consistency in the application of accounting policies, we mean the same accounting policy should be applied on financial statements from last year to this year, or if we are comparing two different entities from, they should all be using the same what? Accounting policies. Now, if somebody is capitalizing an item and another, maybe last year we capitalized something, but this year that item is being expensed, then that means there is a change in accounting policy. That means we cannot compare that item together because we have changed our accounting policy. So this is where IAS 8 will come to town, accounting policies, changes in accounting estimates. And I will share my thought on that pretty later on. So if previously we were capitalizing something, but now we are writing it off, that is a change in accounting policy. Are you getting it? And we'll get into that later on in our discussion. Yes, Kofi, your hand is up. Or is the old one?
It's the old one, but let me take the understandability.
Go for me.
It means that the information should be devoid of jargons and technical words.
Hey, Charlie. The financial statement should be devoid of what? Jargons and technical words. Okay. Yeah, I like that also. Okay. Okay, that is the idea.
You're laughing at me.
I'm not laughing at you. I'm just excited about the word jargons and the word jargon you use. That's all.
Okay.
Right. So yes, that what Kofi is saying is true. The financial statement should be devoid of what? Certain jargons that are not familiar to the users. Why is that important? Because users have just reasonable knowledge of the business and activities of the business. So that reasonable knowledge that users have about the business and its activity, we should use based on that to prepare our financial statement as well. That is why in the financial statement, usually you will see just simple things, revenue. You all know revenue, cost of sales. At least if you're an investor of a company, you should know what cost of sales is. Gross profit. How can you be an investor and not know what gross profit is? We have to start jailing you in the first time. Because you cannot be a finance guy or a business owner if you don't know these terminologies. So we have to prepare the financial statements in accordance with the knowledge of these terminologies in that case. All right. So yes, understandability is there. Tijani Musa said relevance is useful to its dependence on or influences its decision making. Okay. Elisha Amoli said verifiability financial statements should be able to verify by users. Alquaya use the same word. Yes, Timothy, give me some apple. Let me see. And I old hand.
No, new one. Verifiability. The users of
Verifiability.
The users should be able to use the information provided on the financial statement for predictive and confirmatory purposes.
Okay. For predictory and confirmatory purposes.
Predictive. But predictive.
Okay, predicting. Okay. All right. So predicting.
Predictive. Confirmatory. Yeah.
Okay. Predictive and confirmatory. Wow. All right. So you are saying that verifiability it's when the information can be used by users to predict and also confirm the items that are in the financial statement. Another thing also is that about verifiability is that it simply means that the financial statements should be prepared in such a manner that it will assure the users of the economic phenomenon that it purports to represent. Verifiability. So that is why, for instance, after the financial statements are prepared, auditors will come and what? Audit the financial statements. In a way, the auditors are verifying to see if really the financial statement represents the entity in the manner that is expected to represent in that case. Okay, so I think that is all. Relevance, like Oxbert mentioned earlier, it simply means that any information, okay, I think I have some of these things in my slide. Let me see if I can bring it up here. Where is it? I have some of these things here. Let me bring it up here. Okay, yeah. So relevance means that the financial and non-financial information is relevant if it can make a difference in achieving the objective of financial reporting. To be relevant, all information required must be what? Provided. In other words, relevance depends on materiality of the information. Okay, relevance depends on materiality. Relevance is dependent on the materiality. So if there is something that has to be disclosed in the notes, disclose it. There is a standard called IAS 24, related party transaction. It requires that when a transaction occurs between related parties, then you're supposed to disclose it in the footnotes. That is relevant. So for instance, let's say, let's give an example. So let's say my company, okay, let's say my company has whatever. So let's say NP Limited. And then let's say we have my wife's company, and that could be called QC Limited. So let's say that my wife's company renders a service to my company. Stay with me carefully. My wife's company renders a service to my company. So, then the issue is going to happen is that, let's say the service they render to us for third parties, they will charge them, let's say, $10 million. Stay with me carefully. I just want to explain relevance to you with this example so you understand what's going on. But when they render the service to me, I mean, I'm the husband now. I mean, so she cannot charge me $10 million. So she charged me $2 million. Are you getting it? So she renders the service to my company and she would have charged 10 million, but she charged me 2 million. Now, according to IAS 24, I am supposed to, as part of the financial statement of my company, disclose in the notes that this service was rendered by my wife's company and they charged us 2 million instead of 10 million. That is relevant so that my shareholders, if they are happy and say, oh, their earnings per share and their dividend per share is higher this year, they should know that the reason why it is higher is because my wife rendered a service to us and literally dashed us $8 million. And Nuntina, their earnings per share is high and their dividend per share is higher. That is relevance. That is what we mean by relevance. But if I don't disclose it in the notes, then I keep quiet, then I'm denying users of the financial information, my shareholders and other users, a vital information such as this. That is the concept about what? Relevance. So any information, both financial and non-financial, that will impact on the decision makers, the decision-making ability of the users must be provided or disclosed in the financial statement. That is the concept of relevance. That is the concept of relevance. Sharon said, please, what is faithful representation? Yeah, I'm going to come to that. Timothy said, not only Oxford. Okay, that means I dream bonnie about dream. Thank God I removed that dream bonnie. So that is a concept about relevance. I hope that is clear. I hope that is clear. If there are any other questions, please raise your hand. I bring you up. I'll bring you up or you put it in the chat for me. So that is the idea about relevance. Then faithful representation. What the heck is faithful representation? Let's go there in the slide and pick it up. Faithful representation. You see, the financial statement we prepare must represent the economic phenomenon it purports to represent. In other words, don't lie to us. Okay, don't try to use creative accounting. Don't do window dressing. Don't try to embellish the financial statement. Don't try to garnish the financial statement in such a manner that it becomes so good to be true. So faithful representation simply means that to be useful in financial reporting, information must be a faithful representation of the economic and another phenomenon that it purports to represent. But to describe faithful representation, it means that information should be what? Complete. It means disclose everything. So if I go back to my wife's and my company's example, if I recognize the transaction in the books, but I don't disclose it in the notes, that means the financial statement is incomplete. Does that make sense? That means the financial statement is not faithfully represented, because I should tell my shareholders that we got a benefit of 8 million from my wife. So if they have any thanks, they should give thanks to my wife for dashing us $8 million. But if I don't disclose that in the notes, it means I have not adhered to faithful representation. Number 2, it means that the information must be neutral, meaning there should not be any bias or conflict of interest. It should be free from what? Bias. So, the typical manager will say, hey, we will still put it under the carpet. So sometimes maybe I'm the CEO of the company, then I'll tell my wife that, hey, honey, just issue, this company, we've suffered for this company. They are not giving us anything. So, honey, you know something? Just issue the 8 million like that. Just issue the 10 million check like that. But you are charging me 2 million, right? So the 8 million, we'll use it to do something else. You see, so that we can also benefit. We are struggling. This company, I've worked for them. So sometimes management will still recognize the transaction as 10 million, even though they paid 2 million, so that they will pocket the 8 million. When they do that, that means they are being biased. There is a conflict of interest coming in. But that means the financial statement is not faithfully represented. And then the last one is that it must be free from errors, material errors, to be specific, material errors. The financial statement must be free from material errors. These 3 things, which when present, are the things which when present, we can say that the financial statement is faithfully represented. It is complete, it is free from bias, and it is free from material errors. Any questions, please? I'm seeing a chat coming up. Let's see. Sharon said, it looked like faithful representation and relevance is the same. Or yes, they have connection there, because that is why they are fundamental, because they go hand in hand. Are you getting it? Because if you don't disclose everything that is relevant, that means the financial statement is not faithfully represented. And that means you are also not preparing the financial statement in accordance with the fundamental principles of relevance. So yes, they are intertwined. That is why we call them the fundamental qualitative characteristics. The two sets the tone for the way the financial statements are supposed to be prepared. Yes, Timothy, your hand is up.
With this faithful representation, let's say that the company is aware, or then the market, there's a general price for the thing. But when you go there, or you go there, you know that you are already in financial business, so you try to bargain, and they reduce it for you.
Right.
So in that context, say the money is for you, because when you went there, so when you go back, I say no.
Well, I thought because I receive it. As a manager, you don't do that. The money is not for you. It's easy. That is one of the qualities of an accountant: integrity, which is the mantra of ICA. Integrity. You need to be honest. It's not yours. Don't go and use it to sow a seed at church or use it to pay a tithe. No, it's not yours. You bought the thing for $5,000, but they had budgeted to spend $8,000 on it. Come and report the truth. That's all. It's not your money. It's not your money.
Like, I'll report the truth, all right. But I said the money is mine, so I'm not giving it to them.
Why would you give it to them? You have to refund it. Come on now, you can't do that.
You talk about this one later.
You can't do that. It's something you cannot do. You have to be honest. You have to be honest with it. Yeah, I know. Maybe your senior level managers, they will benefit from that, but you have to represent a thing. It's just honesty. It's being honest with yourself. And I mean, I was the one who traveled and I was the one who negotiated. That is why the company pays you. Why is the company paying you? One of the reasons the company engages professional is to reduce costs or minimize costs. So how can we operate and minimize costs? So if we budgeted 8K, but you went there, you negotiated or you use your skills to get it as 5,000, bring back the money and maybe you get some bonus, but don't pocket it. Come on, man. I know, Timothy, this one part here you won't do, but you have to do it. It's just integrity.
On the book that we do it.
I dream boninipa. So that is it about the qualitative characteristics of the financial statements. Any questions, please? Any questions again? Any questions? Okay, so I'm seeing a chat coming on YouTube. Let me see if I can take one. Philemon said, auditors are the guys trusted. Thus, their ethical behavior should not be questionable. In terms of related parties, they're always the
highest. Minister of Finance are causing confusion.
Why no? Timothy won't. I
beg.
Akwawi. So we will say I nominate as Minister of Finance in the next 30 years.
But you know, Ben, man.
Timothy, the contract, why?
There's a dream Bonnie Collins also. Yeah, man, in your nomination, you know. You're nominating and I started demonstration. And they never call court say, oh, this guy is not fitting for the job. You collapse the country. Okay, so let's get the last part. Underlining assumptions. Underlying assumptions. Now, when we are preparing financial statements, there are a couple of assumptions that we are going to be using generally for the preparation of the financial statements. And primarily, there are two, that is the accrual basis and then the going concern basis. These are the two. You understand the accrual basis? The accrual basis and the going concern basis. accrual basis and going concern basis. These are the two fundamental underlying assumptions that must be used for the preparation of financial statement. In other words, when we are preparing financial statements, these two things should guide us. Now, there are other accounting policies. Okay, there are other accounting policies like substance over form, business entity concept, prudence concept, realization concept. I get in it. So there are others there that should guide us, like the prudence or conservative concept. Okay, prudence or conservative concept, business entity concept. Substance over form. Okay, these are all other ones that we will be using though in the preparation of the financial statements, but primarily the underlying ones, okay, that we must use are the accrual basis of accounting, and then what's the going concern basis. So let's just run through them. Who can share some thought with me? These ones, you did them in KG3. This one is not KG2 aspect, it's KG3. Yes, Timothy, what you got for me?
Going concern.
Go for it.
This assumption that the company will operate in the next accounting period, that's the next 12 months.
Right.
Will be no operation
Right.
next.
So that's it. So the going concern, it's seen as refers in the preparation of a financial statement. So it refers to the assumption that in the preparation of financial statements, the entity should be seen as able to operate in the next 12 months. In other words, when we are preparing the financial statements, we must assess the going concern status of the company. Very important. So before we begin to prepare the financial statement, we must assess, can the entity operate in the next 12 months? If it happens that the entity cannot operate in the next 12 months, then the financial statement will not be prepared on a going concern basis. Then in that case, the financial statement will be prepared on a break-up basis, meaning we have ended the business, let's sell assets, pay liabilities, and give the rest of the money to the shareholders, period. So in the preparation of the financial statements, we need to assess the going concern status of the company. If the entity can operate in the next 12 months, apply the going concern. Don't close the accounts. You have brought down and then brought forward in the next accounting year. But if the entity cannot operate in the next 12 months, then you have to close the accounts. So we won't have any brought down, carry down. All we will have is closing the accounts. And like I said, we close the business and go and sell something else. Ernest says, accrual concept refers to the assumption that transactions should be recognized when occurred and not when cash is received or paid. Yeah, that is true. Not when cash is received or paid. That is very true there in that case. So yes, we can say that there for that. So that is our accrual basis. So I'm not going to say anything about that again. It is where transaction is recognized, not when cash is received or paid, but when the transaction takes place. So immediately the transaction takes place, we are supposed to what? Recognize it in the financial statement. We are supposed to recognize it in the financial statement. The opposite of that is cash basis. That is where we recognize transaction evidenced by cash receipt or cash payment, but we are not doing that in financial reporting. So, I mean, we don't talk about it. Yes, Oxbet.
Yeah, so the prudence concept is where entities are prohibited from recognizing future profits but are allowed to provide for future losses.
Right, that is true. So that is the prudence concept. So the prudence concept states that entities are prohibited from making or recognizing future profits. Okay. However, they are allowed to recognize expected future losses. It is the prudence concept that brings about issues about provisions. Okay, like provision for bad debts. Okay, provision for discount allowed. Okay, those things. These are the prudence concepts. Then that is where we will deal with onerous contract, and then the expected contract loss will be recognizing and writing it off in the P&L accounts at the end of the day. But the entity cannot say, oh, we expect that next year we'll make a profit of $10 million, and they put that in the financial statements. No, you cannot do that. You cannot do that. But you can say, oh, next year people owe us $2 million, but 10% of that money will not come. So we should recognize $0.2 million as what? Provision for bad debt. And that is a prudence concept. It's allowable. It's allowable. So you can make provision for expected future losses, but you cannot make provision or recognize expected future gains. Expected future gains. You cannot recognize that. Yes, Timothy, your hand is up.
Please, how does this accrual basis conflict with those who are still using the receipt and payment this in their organization?
When you say receipt and payment, what do you mean? Because receipt and payment is cash book. Receipt and payment is cash book. And when you're preparing the cash book, you are going to use the cash basis of accounting. It is when you are preparing the financial statement that they use the accrual basis. So receipt and payment is cash book. So we have to use the cash basis of accounting. Okay. All right.
Okay. Then I'll talk quick one. I'll talk about the substance of a form.
Go for it.
This is where a transaction or event is recognized based on the economic value or the commercial intent, and not based on their legal form.
Right, right. So that is substance of a form. It refers to the recognition of transaction in its economic nature, not in its what? Legal form. So for instance, when you lease an asset, the asset is not in your name. So by law, since the thing is not in your name, you are not supposed to put it in your books. Do you get it? It is not in your name, so you're not supposed to put it in your books. But you are the one who uses the asset. You are the one who depreciates the asset. You are the one who maintains the asset. So it means economically you control the asset. So because economically you are the one controlling the asset, you will recognize the asset in your books. That is the concept of what? Substance over form. So we recognize the commercial or economic phenomenon of the transaction over its legal form. That is substance over form. Recognizing transaction based on their economic phenomenon or commercial substance over their legal form. Ernest Nkrumah said, I believe Africa introduced prudence. Why are you saying that? Look at Ernest too. Ernest said, I believe African introduced prudence concepts, always thinking negative. If not profit, while losses. Oh, no. It wasn't introduced by Africans. It's just good to, it's not that you are negative. You are just being reasonable. Let's put it that way. You are just being reasonable. You know, someone owes you. Let's say the person owes you $2 million. Maybe the person owes you. You expect the person to pay you the $2 million. But this economic hardship and the Akufo-Addo and the whole issue going on globally, what if the person is not able to pay you? Okay, what if the person declares bankrupt and you don't get the money back? So you are just doing the what if down, and then you are making provision for that in your books so that in case that happens, you will take care of it. It's like insurance. Are you getting it? Nobody says your house should burn or your car you should have an accident, but there is an insurance policy covering that, so that when you pay the insurance, then if the event occurs, then you get indemnity. So it's not that Africans are negative or they are being negative. It's because of the fact that incidents happen. Negative incidents will always happen, but it is prudent for you to make provision for it so that when they happen, you are not surprised again. I get it. When they happen, you are not surprised because at least you had done it already. So it's not that you are negative and it's not an African thing. Okay. It's a global issue. All right. So that is it about the prudence concept. Then the last one, business entity concepts. Business entity concept. The business entity concept states that a business should be seen as the one separate from its owners. I get it. A business should be seen as the one separate from its owners. So that is why the economic entity, okay, is separated from its owners. Typically, that is where any transaction that the owners undertake will be treated as what? Drawings. And you will see the business entity concept usually when you're dealing with a sole proprietorship business or you're dealing with a private company whose owners are the same as the managers. So you see that they are collecting money with their right hand and they are putting the left hand inside for personal consumption. Yeah. If you go and ask them, you are the accountant and you ask them, you say, hey, is it your company? You don't even, you dare not even ask in some cases. Is it your company? Authorize the check. Authorize the check. Let me go and spend the money. You are saying that it's not for, hey, Jama Bibi, yo. Come on, withdraw the money. Let's go. So if you are dealing with a private company that is also managed by the owners, and the business entity concept will come in so that anything that the owner takes, whether cash, inventory, or all that, they will be treated as what? A reduction to their share capital or to their stated capital in that regard. So that is the concept about the business entity concept. That is also there to guide us on how to treat transactions so that when owners of the business take something from the business, you don't put it in the name of the business. You don't do that. You don't do that. So if they take goods, that goods they take cannot be part of the cost of sales of the company. No. If they take cash, that cash cannot be part of the expenses of the company. No. It has to be accounted for as cash drawings or goods drawings and reducing their capital in the business in that case. So these are the assumptions or some of the assumptions that are used in the preparation of the financial statement. Like I said, the basic ones are the accrual basis, then the going concern basis, and that sets the tone for us to be able to prepare financial statements at the end of the day. So that's it about that. Any questions, please? Any questions? Any questions? So these are the 5 key issues that we need to understand when we talk about dealing with the conceptual framework for the general purpose financial statement and the elements that we have to pay attention to. And this sets the tone for us to now begin our journey proper on financial reporting. Any questions, please? Any questions? Any questions? Our next discussion will be on ethics, and then evaluation of financial statements. Ethics and evaluation of financial statements. Ethics and evaluation of financial statements. Yes, Sister Gladys.
Nhyira, good evening.
Good evening, ma.
Please, with the cash drawings.
Right.
Just as you said that when you are dealing with a private entity and then the owner decides to come for money from the company, but decides to tell you that he's going to use it to venture into a different business.
Okay.
But you yourself, you know that, oh, this is not
Ogodi.
it.
Okodi.
Okodi, but just as you said. So how do you go about that in
Okay.
the
Financial
report?
statements.
Mm.
It's drawings. Only that, like you said,
So
he or she may not allow you to account for it as drawing.
yes.
So technically, the double entry would be that you're supposed to. He will expect you to maybe treat it as receivables in the books. So it's a loan to him. So it would have been treated as
A loan to
receivable
him.
or loan receivables. Then you credit the cash or bank. But he will not. This is what he will expect you to do, like it's a loan. But technically, this is not what is supposed to be done. So because he is going to chop the money, we will debit. We can use it to reduce the retained earnings. So we can debit retained earnings with that amount that he has drawn. So it's just like a dividend we are giving to him. So let's say that he took dividend from the company. Okay. So we will debit retained earnings because retained earnings has a credit balance. So it means you deduct this from retained earnings and you credit your cash or bank. Does that make sense?
Okay.
So that is it. So and if he allows you, fine. Because like you are saying, I mean, he may not allow you.
Practically, in this part of our world, it is very difficult.
It's serious.
Ethics, I mean, if you don't take care, you lose your job.
Straight.
Oh, yeah.
Not that if you don't take care, you will lose your job.
That is what I was saying. He will ask you, when I started this company, you were in diapers.
Where were
you? Who are you to come and tell me how to chop my whole company's money? This is my sweat. Jamal Bibi, yo. Like he will be sacked immediately.
It's serious.
Now, when auditors come and maybe that is where talks will come in. And then sometimes even GRA, sometimes when GRA comes and they are doing tax audits, then questions may come in. So if he has a way to defend, maybe you are the accountants, you just disclose it that he said he's going to use it for another venture. So then it becomes a loan receivable. Then and that related party.
You wouldn't even know where that venture is.
Yes, documentations become an issue, a big issue.
Documentation produces. There's nothing like the certificate of contract and all those things. Nothing.
Nothing.
So
I mean that is the unfortunate thing. But like I said, you have to go by what he has said. No, but you need to just inform him or her that, boss, please, when auditors come and they're looking for this, then he will tell you, hey, I'll deal with that. So don't bother your head so that you can keep your job at least. But and you will see this in the private company, like we mentioned. In a publicly listed company or public interest companies, you will not see somebody chopping money on that level. When that thing happens in public companies, it is a fraud, more or less, and that may not be entertained in that regard. So if that happens, just follow it so that you keep your job at the end of the day. Make sure that disclosure is done well in the financial statement. When auditors come, you can defend yourself, or you can refer them to your boss to talk about it.
Okay, thank you.
All right. Look at Ernest. Ernest said to treat as side chick allowance. You are crazy, eh? So the money is for side chicks. Your big head. All right, so that is it about that. Basically, in that regard. Joseph, your hand was up, but you have put it down. I don't know. You wanted to say something or something like that? Okay, so that is it basically about that when it comes to dealing with the introduction to public sector accounting and finance. We just wanted to set the tone up today and also provide you with the various fundamental issues that we need to understand. From next week, we are going to be starting to chew the bigger meat, and that is to talk about ethics and to talk about the ratio. So for those of you with the book, you can read it ahead of me, or you can watch the video on the portal so that when we come next week and we are discussing these, you will be enriched with understanding better, and that way you put yourself in a better position to pass the examination. Note that ethics is all other things being equal between 5 to 10 marks for us in the exam hall. And evaluation of financial statements is also a done deal, 20% coming in the exam hall, 15 or 20%. So it's a huge area. Next, we will touch on these two aspects, and we will continue with a discussion from there. So that's it about that. I will conclude here. And in the next 12 weeks, we're going to dance like this. Your assignment today is just a reading assignment that I gave you, that you should go and read on uses of financial statements, and also, your friend is a processes of certain standards. Okay, processes of certain standards. If you have any financial reporting book, or you have a book, like, you will be able to read those things there, basically, and then have some idea about that. From next week, the assignment will begin to flow, because when we finish with ethics and we finish with ratios, come on, man, you are going to do a lot of assignments, and I'll get you there. So that's it. Enjoy your weekend, chill out, study, but most importantly, make sure you have fun. That's important. Okay, let me see. I'm getting some chat from here. Ernest said, please, Nhyira, reserve one of the book for me. I will pass by and take it. Financial reporting. Okay, I hear. All right. Let me see. Anything on YouTube? Nothing. Okay.
Nhyira, send me a why. Reserve one for me. Why? I beg.
Okay, Mate. All right. So that's it about that. We will catch you next week. If you have not downloaded our application, you can download the mobile application on the App Store or the Google Play Store. The name is Nhyira Premium, and you can download the app. That way you can get access to content, the lecture videos, and everything as well on the go, to help you to prepare for the exams. So that's it. Good night. Have a great weekend. I'll catch you next week.
Bye-bye.
Bye.
Bye.